Hey everyone, welcome to the final bar. I was all mentally prepared to talk about a distribution today, but in the last hour or two of trading, we start to appreciate and finish in the positive. So a real mega cap led rally to wrap up the day, with mid caps and then small caps really lagging behind. So we're going to talk about what that means. We're going to look at the markets from three perspectives: the big picture macro, the sector rotation, and the stock picking. Hit on themes on all three. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar on a Monday afternoon, May the 4th. Happy Star Wars Day to all of you. This is Dave Keller, your host, Chief Market Strategist here at StockCharts.com in Redmond, Washington. Thanks for joining us every weekday after the close for the final bar. Our goal with this show is really to empower you to make better decisions using charts, using the StockCharts platform, help inform and educate and hopefully inspire you to dig deeper. And in a 30-minute show, we get to touch on some of these great themes, and I hope it encourages you to pursue some of these themes on your own and help to draw some of your own conclusions and hopefully make better decisions as we go on. As we've talked about during this whole experience together over the last couple months, bear markets provide such a great opportunity to grow and learn as an investor. And, thinking of my career now about 20 years in, I've learned so much more in bear market phases than bull market phases. You learn a lot about behavior. You learn a lot about how the charts visually represent the prominent psychology out there in the market. So we're going to get to all the charts. We're going to talk about some of the takeaways. First, just want to highlight some of the great guests we have coming up this week and next on StockCharts TV. Today, we actually premiered our latest episode of Behind the Charts that was featuring Sam Stovall from CFRA Research. So if you missed that, check it out on our YouTube channel. It's a really cool conversation. Sam's a really smart guy, knows his stuff, and he's not a technical analyst, but uses charts as part of his holistic approach. Tomorrow on May 5th, we have Samantha Leduc. On Wednesday, Jonathan Krinsky. And on Thursday, Clint Cowell. So actually three fantastic traders, analysts, market experts to share their perspective on some of the charts at top of their mind this week. Next week on May 13th is our next episode of The Pitch. This is one of our newest shows where we actually have a moderator from StockCharts and then three guest experts all providing some of their ideas, pitching you their ideas for right now, and then have a discussion as a group. We did one about a month ago, had so much fun talking to a group of us about some stock ideas. So I think it's really going to be a cool event given the market environment. So that's on May 13th, The Pitch. So let's get to our market recap. And again, I've mentioned so many times, one of the more exciting parts of my role here at StockCharts is hosting a closing bell show. And it's always been the case that you have a huge influx of volume, huge influx of activity toward the end of the trading day. But I think given the environment, you see these dramatic changes, and a down day becomes an up day in the last hour. It's happened so much, and today was no different. So earlier in the afternoon, I'm starting to put some thoughts together for the show, and looking at the market, I'm seeing things lower. And then by the end of the day, we sort of rallied in a position of strength. So the S&P finished about 2843, just below that. That's 0.42% positive. I think it's worth noting mid caps were flat on the day. Small caps were actually down. So if you look at small caps, sure, they rallied toward the end, but still finished in the negative. So this is really the mega caps sort of saving the day and stealing victory from the jaws of defeat based on today's trading. The VIX back down to 36, just below 36. Looking at bonds, the TLT was down about 0.5%, with the TLT just above 167. Looking at the dollar, up a little bit, with the UUP trading just around $27 a share. That's up 0.5% from Friday's close. In terms of commodities as a complex up pretty decently. Oil up the most. The USO was up over 4% today. Natural gas up 6%. Energy was the number one sector today, up 3.4%. With the average stock up a lot less than that. Gold up 35 basis points, so sort of the safe haven of gold, not down on an up day, but actually up as well. Let's look at a chart of the S&P 500, and then we'll dig into some of the individual themes as we go on. And as a reminder, on Mondays, I love the show because we hit the big picture here. We look at sectors, we look at stocks, and it's really the three ways I would hope you approach things from a technical perspective. I think if you do each of those three with a regular process, you're going to be in pretty good shape, understanding where things have come from and where they're potentially headed. So, looking at a daily chart of the S&P, you've probably picked up on the fact, and people have made comments. My videos on our YouTube channel when we post this show usually has some bearish headline, because I've been talking about this bear market rally for certainly a month or so, and I still think that's how we're going to end up playing out here. And as we talked on Friday, I feel like everyone feels validated. If you've been in the everything's fine, we're going to go back to previous highs, you're feeling pretty good because the pattern remains higher highs and higher lows. And even with the pullback Friday, and we had a little bit of a lower low today, but closed toward the highs, we're still making a higher low from a week and a half ago. So that pattern, that short-term bullish pattern, continues. But if you're more in my camp and you're seeing this more as a bear market rally and some potential further downside, you're feeling pretty good as well, because we've reached sort of that sweet spot. We reached the 61.8% retracement, and we haven't gone any higher. We haven't quite made the 200-day moving average right at 3,000. So there are a lot of reasons why this could be a legitimate place. What's interesting now is today's low was almost right at 2,800, which is almost right at the 50% retracement of the February to March low. So we're right at the midpoint. So we now have this lower, if you think of the low of today, 2,800, the high of last week around 2,970 or so, we sort of have this range. And at some point, we're going to break above 3,000. We're going to break below 2730, let's call it, which is the low from about 2 weeks ago. It was the most recent swing low by my read. So one of those has to break. We have to break to new swing highs or new swing lows, and I wouldn't be surprised if that breakout direction gives us that gives us the momentum really to follow. As I mentioned before, the fact that the RSI has topped out right around 60, again, that would be such a classic bear market phase if we would sell off from here. But again, let's be clear, as long as the short-term pattern remains higher highs and higher lows, the short-term trend is positive, and that has not changed yet. Talking about sectors, as I mentioned, energy up and oil prices higher, energy up 3.4%. As I go through on the weekend and look at the S&P 500, the individual stocks within energy, we're going to look in a little later, things like Valero, HFC, E&P stocks, even the integrated, just this classic uptrend pattern in the short term. So they're really and outperforming dramatically in the last 4 to 6 weeks. So there's really some interesting charts emerging there within energy, again, but just coming out of such a beaten down place. Number two was tech today, up 1.33%, which is pretty important. Whether or not technology can continue to thrive in this environment is a key question we need to answer, followed by utilities. At the bottom, we had industrials, financials, and real estate. And we're going to talk later. I think one of the 3 and 3 charts is looking at ratio of financials to technology. We're not going to get to all of the stocks. And again, when we talk about stocks, there's so many interesting patterns to talk about. I did want to point out the airlines down pretty significantly, though. So airlines are one of those beaten down groups that rallied so quickly last week that it felt like, okay, finally, if airlines are getting a bid, people are really buying the beaten down stuff. They all came down pretty heavily today. If you look at Delta, it traded back down toward the lower end of this range that we've had for the last 6 weeks. Finished strong, though. So down 6.5%, but really finishing stronger relative than weaker. We can compare that to things like United, AAL, and they all kind of have a similar pattern, sort of toward the lower end of that range. They've come off a bit, making lower highs. And the concern with airlines is you have this sort of coil pattern, the symmetrical triangle, lower highs, higher lows, potentially starting to break down. Had we finished more at the lows today, I would tell you that is absolutely a sell pattern suggesting a breakdown. The fact that we closed more toward the highs, though, makes it feel like there was a bid coming in, people buying in on the weakness just during the trading day today. I'm pushing it back in. But it's worth noting that that all those airlines down pretty significantly on an up day. In terms of other groups, a lot of energy in the top 10. So 4 of the top 10 industry groups, all within the energy space, pretty much across the board. Again, we'll look at a couple of those charts later on here in a minute. I did want to point out that gold miners and Newmont Mining continues to be the #1 stock according to our Scooter ranking. So the fact that gold miners are still doing very well in an environment where stocks are continuing to rally is an interesting one. That's not something you would probably assume based on normal market history. That's our market recap for today. I want to move right on to our next segment, which is called sector setup. So we love to do on Mondays, look at the sectors, do sort of a top-down review of those of the S&P sectors, and then think about how the sectors relate to what we talked previously, the macro, and then also when we get into our next segment, shifting stocks, how these all are sort of interrelated. So when we think about sectors, I start with the RRG graph. And what's interesting is technology. About a week ago, I feel like when we did this, right at the point where it's going into the weakening quadrant, and I was pretty much assuming that was going to be the case. And it's a live chart, and at times it had actually turned yellow, broken that threshold into the weakening quadrant. But as you can see, it's actually come back up into the leading quadrant. So it didn't quite get the follow through of going into the weakening quadrant. And just in the last week, it's actually turned northeast again. And if you think about it, a lot of the tech charts have actually held up very nicely. Apple's probably the one that comes to mind, the most. And looking at, a chart of Apple's one of the biggest stocks within technology. Look at how the relative strength is, at a new relative high for the last year. I mean, this is a multi-year relative outperformance trend that we've seen, and it's just had this nice, real classic V bottom, selling off into the March lows and now reversing it. So if you didn't think about everything else we've talked about, it actually is just in this nice consistent uptrend. It feels like this nice sort of the type of core name you'd want to own, and the relative strength certainly supports that. So what's interesting is when you look at the RRG, it didn't have the breakdown that I was starting to see there. It's actually holding up in the leading quadrant. Okay. Now, having said that, healthcare has certainly emerged as the strongest of the 11 sectors. I think that's continued to be the case. And again, furthest to the right means it's the strongest relative picture, and it's the S&P right there in the at the crosshairs in the middle at the 0 point. So healthcare, consumer staples, technology, all sort of in the strongest point. Tech had been weakening. It's starting to stabilize a little bit, and I think if it's able to reverse course as it is, turn to the left and head northeast again, that would be a dramatic improvement for the overall take on the market environment for sure. Certainly showing some stability within technology. If it, however, continues down southwestish and heads into the weakening quadrant, speaks more to a leadership rotation. Consumer staples had been one of the better sector plays in terms of the relative rotation graph, had rotated northeast. You can see in the last couple of weeks, it's actually rotated lower. And in a second, when we look at the candle glance page, you'll see consumer staples, utilities, which is actually nearing the weakening quadrant as well. These were two sectors actually testing their 200-day moving averages from below, failed there, and now are actually in the short term, just as the S&P is making higher highs and higher lows, those sectors are doing the opposite. They're making lower lows and lower highs. So you're seeing this reversion away from consumer staples, relative safety of some of the consumer staples, maybe some of the coronavirus plays, and actually rotating more towards healthcare, back into technology potentially. Worth noting, consumer discretionary as well, really starting to improve. And in our shifting stocks, we're going to spend a little bit of time on some consumer names. And a lot of the stocks like Ross Stores are just having these nice constructive short-term patterns. Industrials, financials, according to this methodology, are still in a void. And again, just based on a relative rotation, other things are just rotating in such more a position of strength. It's worth waiting on. Interesting to see energy rotating so strongly. And again, it continues this course of rotating to the northeast because of how bombed out they are. They are not going to go very quickly. It's going to take, it's sort of the Titanic reverting, changing course here in the lower left of the RRG work. But at some point, we'll probably head northeast, and I think it's certainly worth thinking. As we look at some of the individual chart, you see there's certainly some potential upside in those in some of those stocks. Looking at the candle glance, second thing I like to do after the relative rotation graph is focus sort of high level at the sectors and then look at some of the individual charts. On Friday, we highlighted 3 of these sectors as part of our 3 and 3, and I'm going to start with those. We looked at consumer discretionary, staples, and utilities, if I remember right. So, consumer discretionary, I'm always looking for a chart that gives you a good proxy for, where the overall market is, some sort of signal you can, jot down, focus on. So instead of having to look at hundreds and hundreds of charts, just focus on a couple that I think are really pivotal. And if you think of sectors, I think those are the 3 to look at. If you look at consumer discretionary, we've tested a declining 200-day moving average from below. It has failed, and Thursday, Friday of last week really came off of there. We've now potentially set a new higher low. The last low was about 2 weeks ago back here, this low from mid-April. We've now set a higher low here around 110 today. Again, this is just today rallying up a little bit. We have to see what the next couple days brings. But if this pattern continues, certainly more constructive than destructive, but we do need to get above the 200-day moving average. We've been unable to do so, and it's pretty standard, pretty classic from a technical perspective to fail at the 200-day from below, just like you would fail to break down through it, because that's where a lot of people would look as an opportunity to build long positions if they're longer term investors. Same thing here. If you are looking where to take profits, a lot of times that ends up being a pretty decent place to do so. So if and when it's able to reclaim the 200-day, that's where you assume more positive momentum, more upside, but it hasn't happened yet. Now compare that chart with the chart of consumer staples, and you can see that this has actually continued lower. So while consumer discretionary is sort of right here, and arguably potentially starting to retest from below, consumer staples actually closed above the 200-day a couple times. This is in early to mid-April, but since then has now established a lower high and now established a lower low. It's back down to the 50-day moving average. And so in this case, in that short-term tactical trend, actually now in a downtrend, and also relate that to the chart of utilities, you'll see sort of a similar pattern. So while some of the sectors actually holding up, we'll look at technology next, some of these sectors actually are in that short term actually going into more of a downtrend, lower highs, lower lows. And again, until that pattern changes, the short-term trend is down. The relative strength on utilities, if you look here at the bottom, is actually at the lower end of this range that it's been for the last year or so. So it's certainly had this period of underperformance when it had been one of the better places to be going into the market sell-off in early March. Other sectors have just done better. And then finally, I'll finish with technology. So here, looks a lot like the chart of Apple. The relative strength had been stabilizing, coming off a little bit. You had the market rallying with tech actually making lower peaks, but look at how the relative strength has improved again. You're actually seeing it test a new relative high for the last 2 years, which is pretty impressive. So this technology just continues to be resilient. It's that mega cap tech trade that just does not want to die. And again, as long as that continues in this trend, it's hard to think anything but a good, pretty consistent uptrend for the overall equity universe. So that's our run through some of the sector themes. And again, we didn't get to all of them. Financials, I think, are really challenging. We're going to get to a chart that I think speaks to that relationship a little later in the show. We're going to take a quick commercial break, be back with the next segment, Shifting Stocks. We'll see you in a minute. Hey everyone, welcome back to the show. I'm your host, Dave Keller, here at StockCharts.com. As a reminder, a couple times a week, we do a mailbag segment where we answer your questions. We've had such fantastic questions, given the environment, I think given a lot of uncertainty. So please send us any questions on the markets, on market structure, on technical analysis, on behavioral finance, on particular tickers or charts. Anything is open and fair game. Just shoot us an email, thefinalbar@stockcharts.com. or tag us on Twitter @FinalBarSCTV. We'll capture all of those and answer as many as we can on the air. We'll do our next mailbag segment tomorrow. So we'd love to answer your question on our next show. Next segment is called Shifting Stocks. So this is the third piece of our Monday routine, looking at the big picture, looking at sectors, and now looking at individual stocks. And I hope even those of you that don't trade individual stocks as much, if you're focusing more on ETFs or more on broad market equities or futures, I would encourage you to look at individual stocks as part of a regular routine. So part of my weekly routine over the weekend is to look at all the S&P 500 names and just do a bottom-up process. What patterns are emerging? How do I feel after looking at all of those charts? And a lot of times it helps to inform the way that you look at some of the other charts, because a lot of times I found the broad measure, the broad chart of the S&P oftentimes is the last place that you'll identify a market turn. It will emerge from some of the individual stock charts. You'll start to see weakness emerge there or see strength emerge there that won't be reflected on the broad S&P until a little later. Having said that, I just want to share with you some of the charts that I jotted down as I was doing my routine looking at the S&P. Again, I hope this encourages you to do your own process, take it from here, and continue on. We'll start with in communication services. I usually go through the 11 sectors in alphabetical order, more or less. And so I start with comm services. You know, the media names in general are all sort of have sort of a similar pattern. They're not necessarily bad charts. And that's what struck me. As I'm looking at a chart of Comcast, it's not horrible, right? Especially out of the lows, right out of the March lows, you have this pattern of higher highs and higher lows. That feels okay. And even with the pullback, you're still sort of getting a higher low. That the third, fourth week here in April, that low around 35.50. I think that's the key one to stay above, and we haven't broken that yet. So that's not bad. And less than a week ago, it was making new swing highs, so that's not horrible. What concerns me, though, across the board with these stocks is the relative strength. You can look at Comcast. So even though it's held up okay, and it's not a bad chart, on a relative basis, it's making a new one-year relative low this week, right? So I mean, it's just not as attractive as some of these other places. So while other stocks have also rallied from the lows in March, they've done so in a much more effective way. Disney's another one. Again, we're not going to get into the fundamental stories as much. It's trying to just focus on the charts here. But with Disney, you have a stock that has rallied again less than a week ago, making new swing highs, which is good. And I think that sort of 107, 108 level, the swing high from here in March and April is really important. We broke above there, but we weren't able to sustain that, which is a concern. Just below 100, this is the most recent swing low. So if we stay above that, that's good. If we break below that, I think you have to start to question the stability of this. But again, the relative strength, it's not just a recovery period. It's not just the last 6 weeks that have been relatively poor. This is the last 8 or 9, 10 months where Disney has been an underperformer. So until some of these communication services names start to improve, I think it's a bit of a concern. Now, having said that, within communication services, you do have some relatively attractive charts. Facebook comes to mind, making another new relative high last Friday. That's continued today with it up 1.5%. Doing very, very nicely. RSI is above 60, so it's more in a bullish range, nearing the overbought range. We're nearing the previous highs here from January. So Facebook actually topped out in January, while the market topped out in February. This topped out a little earlier with a lot of the healthcare stocks, but nearing that range, that 215 to 225 range, which is where it topped out beginning of this year. So, we're approaching some significant resistance, but overall, you have to feel good about the performance of Facebook. The other thing within communication services, these are two earnings names this week. We have the video game stocks, Electronic Arts, Activision. There's some others in there as well. But on a price basis, EA has made new highs again not too long ago. Since breaking above the January peak a couple weeks ago, it's maintained that sort of range up here, sort of broken up and now holding above those levels and testing a previous high just above 118 on a relative basis, holding up very nicely. Activision is the other one, ATVI in that same group, even more constructive, just positive, breaking above the previous highs, now coming back and retesting from above. Pretty attractive chart. So within communication services, one of the reasons why those media stocks look so unattractive is because stocks like the ones I just showed you look more attractive. Within consumer discretionary, I can summarize all of them, probably or most of them, with this one chart. Ross Stores, and this is the non-Amazon part of consumer discretionary, sort of the traditional retailers. Ross Stores is a pretty decent example of what they look like. They've all rallied very nicely out of the lows. They are not outperforming to a significant degree, so they're sort of market performers after that first leg higher. They're all making a consistent pattern of higher highs and higher lows. So as long as charts like Ross Stores continue that pattern, you have to feel okay about the sector. If and when that pattern breaks, if you start to make a lower high and a lower low, that's where I would get concerned, but it hasn't happened yet. With all of these, though, pretty much across the board, the RSI topping out at 60 so far, which again is more of a bear market sort of configuration. We're going to go quickly through a number of charts, try to hit as many charts as I can. As I mentioned, within energy, I'm not a huge fan of the energy play, only because as a trend follower, as a long-term trend follower, it's just hard to believe that they can turn this quickly and that there's stability there. It still feels like this bottom fishing, blowout rally out of the lows. Having said that, if you look at VLO, this has outperformed the S&P by 26% just in the last, it's brought back. It was down as much as 50%, now down 24% essentially from the end of last year. So it's almost half that sell-off here. So it's had an incredible rally. The momentum out of the lows is extraordinary. And it's not just Valero, it's across the board. HFC is another one within exploration and production, E&P names. And what's interesting is the relative strength, while stable for a while, now all starting to turn higher. So, is it worth taking a bit of a nibble if you haven't already, potentially, right? Just because of the strength of the relatives coming in there, even if it's not the best thing ever. These names are all up significantly, continue to outperform. Energy was the number one sector today. I did want to point out the number one stock out of all of our large cap scooter rankings is a gold miner. It's Newmont Mining, NEM. This looks very uncharacteristic relative to other stocks, continuing to make new highs, sort of up and to the right, above two upward sloping moving averages, continuing to be in this overbought sort of healthy range, and the relative strength really accelerating in the last 2 months. It was sort of a decent relative trend going into year end, and then it's really accelerated. Just continue to be a strong relative performer. I think certainly warrants your attention. Within technology, just to wrap up within tech here to finish off our session, I'll try to get through as many of these as I can. I think Apple continues to be a compelling chart to look at, only because the stability of Apple has to make you feel like days like today will continue. Even though small caps were down, big cap tech, the Apples of the market, are what have driven things higher, testing a new relative high for the last year, which is impressive. The relative strength, the RSI right at 60. So if this is able to break higher, we're able to retest the previous highs, continue this pattern, RSI getting above 60, making new relative highs, it would be hard to be bearish on anything at that point, just because stocks like this are clearly able to keep the market holding up very, very nicely. If you start to see failure here, if you start to see the RSI never get above 60, if you see the relative strength taper, if you see this pattern of higher highs and higher lows change, I think you need to be concerned. It hasn't happened yet. Within tech, you have a number of other plays. I think PayPal is a really interesting chart. It's more of a coronavirus play. It's been evolving before then, but certainly accelerating with a lot of online shopping, just continuing a nice string of relative performance. The 2-year chart shows you what a huge base that we're potentially breaking out of in the last week or two. So I think it's a really important one to watch here. Also in that similar sort of group of payment processors, et cetera, you have VeriSign, VRSN. Visa is maybe a bit of an outlier. So Visa and MasterCard actually a little less attractive. When you bucket them with technology, there's some of the weaker charts, only because the average tech name holding up so well. Another one with Visa, testing the 200-day from below with the RSI right at 60. I would love to see that break above there to feel better. Visa was one of my 3 bellwether stocks over the last couple of years. Alphabet, Visa, and JP Morgan, 2 of those not doing nearly as well as one of the others. And then finally, I will finish and wrap up just by mentioning semiconductors. So I think Applied Materials is an interesting one to look at. And again, this is a stock that looked pretty negative on my weekly review, up a little bit today from yesterday's close, but compared to the rest of tech, semiconductors starting to look a little less attractive, which I think is an interesting theme, only because semis tend to do well in a healthy market environment. So you'd want to see those improve if you're more on the bullish side of the docket. That is shifting stocks. Again, I apologize that I'm tearing so quickly through a lot of those, but after looking at 500 charts, I have a lot that I'd love to share with you. Hopefully that inspires you to dig a little deeper into some of those themes. We need to dig deeper right into the 3 and 3 and wrap up the show, folks. So chart number 1, growth versus value. I'll hit you with 3 different ratio charts that I think are maybe interesting to watch at. So today we had a situation where the market starts out lower, finishes higher, and it's really driven by the mega cap growth trades. This growth versus value ratio continues to go up in the right. We're waiting for the return to value. Nothing I'm seeing on these ratio charts tells you it's happening anytime soon. It continues to be mega cap growth leading it. Chart number 2 is looking at the relative performance of financials versus technology, the XLF versus the XLK. The underperformance of financials, which we've seen continue over the last couple of days, certainly continuing today, is not a new phenomenon. If you look at this chart for the last 10 years, you'll see that financials have been a chronic underperformer relative to tech. And the point of bringing this up here is just that's not changing. So if you're waiting for financials are undervalued based on something like this, it's been so beaten down. Again, as a trend follower, I would want to see this trend reverse. I'd want to see financials start to outperform tech before I'd feel great about wanting to own a big bank before I'd want to own an Apple or a Microsoft. And this chart continued to go down and to the right, tells you that theme is not done. And the other way to look at this maybe is looking at the Qs versus the diamonds. One of my guests in recent weeks shared this one. I thought it was fantastic. And if you look at the Qs versus the diamonds, again, diamonds includes Apple and some other big cap tech and consumer and others. But if you look, this ratio is just testing a new all-time high, suggesting that the Qs and NASDAQ 100 continues to be the source of strength for this market. Ladies and gentlemen, that's our show for today. Thanks so much for joining us on the Final Bar every weekday after the close. All of our previous episodes on our YouTube channel, go check it out, along with all the other shows from StockCharts TV. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey guys, Grayson Rose here with StockCharts.com. Thank you so much for watching. I hope you enjoyed this video. Remember, if you did, give us a like down below, leave us a comment. We'd love to hear from you. And most importantly, don't forget to subscribe to our YouTube channel for daily content from an incredible collection of technical analysts and financial minds. We'll see you back here very soon. Happy charting, my friends.